Hearty welcome. Now we are going to discuss about an important topic, cost of capital. See, the cost of capital is the minimum rate of return a company must earn on investments. You have many borrowed funds, you borrowed money from equity shareholders, preference shareholders. You might have availed loans from financial institutions, banks, and company might have issued debt instruments like debentures. For all those things you have to pay the rate of interest, and for shares you have to pay dividends. So the cost of capital represents the expense of using funds from debt and equity, and it serves as a benchmark of a hurdle rate to evaluate potential projects and make capital budgeting decisions. There are two costs you must consider while doing cost of capital computation: opportunity cost and financing cost. The cost of capital is the opportunity cost for investors. It's a rate they could have earned from the next best alternative investment with a similar risk. The financing cost for a company, it is the cost of using funds acquired through debt and equity. So I think there are three components associated with that: cost of debt, cost of equity, and cost of preferred stock. The optimal capital structure can be determined with the help of combining both debt and equity. The optimal combination will help the company to minimize the cost of capital. Already we have seen the cost of capital is the record rate of return of a company must earn on its investments to compensate its investor, both debt holders and equity shareholders, for the use of their funds. And the key components which include cost of debt, you can see the an upper part of the image, and cost of equity, the dividends, what you're going to give it for the shareholders. If you combine both cost of debt as well as cost of equity, they combined into a single metric called weighted average cost of capital, which one we'll be discussing in the subsequent slides. Let me understand the components of cost of capital. As we discussed, the company will borrow money from different sources, so they'll be paying interest and dividend. The cost of capital is derived from different ways a company raises money. Debt includes interest paid on loans, bonds, and which represent the cost of borrowing money. Equity, the real owners' contribution, this refers to the return expected by shareholders, which can be in the form of dividends or the expectation of future stock appreciation. And coming to the preference shares, this is the another type of shares with fixed dividend rate that must be paid to preference shareholders. If you combine all together, the terminology cost of capital will emerge. Once you understand the importance of cost of debt and cost of equity, it is essential to know about the various factors which are affecting the cost of capital. Interest rate, higher interest rate lead to higher borrowing cost. Say for example, if you borrow a loan at 8% and another loan for 12%, so the 4% difference will be resulting in additional payment. Inflation, yeah, high inflation can impact the purchasing power of money. You have to consider the market conditions. Market condition, if it is a stable market, it may result in the lower cost of funds. It's unstable, automatically, okay, you have to pay more. And credit rating, a company, the credit worthiness, which will be reflecting on the credit rating, and which will assist the company to have better control over in cost of borrowings too. Capital structure, The mix of debt and equity financing which affect the overall cost of capital. Debt often has a lower cost due to tax deductibility of interest payments. Coming to the concept weighted average cost of capital, WACC, you must understand what is weight. The weight is what we are giving: weight of equity, weight of debt. Suppose a company owns 60% equity share and 40% debt, so it's going to be a 60-40. Weight of equity is 60, weight of debt is going to be 40%. And we'll be understanding the cost of equity and cost of debt also. So in the formula WACC, that is equal to weight of equity into cost of equity, plus repeat the same thing for the debt too, weight of debt into cost of debt, and finally we'll give an effect for the tax rate also into 1 minus tax rate. Let me give an interesting as well as a practical example to you. Assume that you are starting a small business with a borrowing from your father, rupees 2 lakh, and you have made a promise to pay 3.5% interest. And if you simply calculate 2 lakh into 3.5 divided by 100, it's coming around 7,000. So you have a fixed commitment to pay 7,000 rupees per month, and you are investing that money in business. You are able to generate a 25,000 cash flow, the benefits from your business. In that 25,000, already you have to pay 7,000 to your father. So remaining 18,000 left over, which is said to be a net profit. From that amount, how best we are going to create the thing? One you can plan for principal loan amount can be repaid. A portion of money can be given to your father in above to your interest, what he charges. On the other side, you can do reinvestment too. So very simple, 2 lakh you borrow, 3.5 interest you have to pay, 7,000 you have made a revenue of 25,000, 7,000 went in the form of interest, remaining 18,000. So now a portion of money, 9,600 and add invested in the business again in the form of reinvestment, whereas 8,300 plus is given. It is used to repay the principal amount of money obtained from your father. In the earlier example, we have taken the cost of debt for the money borrowed from your father is 7,000. Now the same thing enlarged in a larger scale. Just think about a business house which is operating with a full scale with both debt and equity. You can see the picture. The center part business is run with the help of two strong pillars. One is debt on the right side, equity on the left side. The money contributed by the shareholders are called as equity, and the lenders, they have contributed debt. So you are investing both funds in the business operations. And once you do a business or once you invest that money in the business operations, it will give you a yield. You will earn money. From that money, you are able to pay the interest. Interest is nothing but cost of debt for the loans and advances. And first you will give a priority for interest, then tax will be deducted. And whatever the money available, okay, that money will be used to declare a dividend for preference shareholders as well as for equity shareholders. Once everything is given, the final amount, which is amount available for distribution to equity shareholders. So now you look at that. Once you do that, you can go to the top of the image. When the business is able to grow, sustain, and the profit earning ability is increasing every year, automatically there will be a good impulse in the stock market too. And you can see with the help of that one, the company is able to give a good growth, and market price will be going up, and the capital mobilizing ability of that organization will go up. So put it in very simple nutshell way, the company must be in a position to earn sufficient amount of earnings to meet out cost of debt, cost of equity. In addition, the company must be in a position to sustain their good reputation in the market too. After understanding from the individual business as well as in the corporate level, now we will come to know about cost of capital. Cost of capital is nothing but the combination of cost of debt as well as cost of equity. How much amount of money you are going to pay for the debt plus how much amount of money you are going to pay for cost of equity. So please remember, cost of capital is equal to cost of debt plus cost of equity. That's a minimum rate of return the company must be in a position to generate from their business. Yeah, the basic objective is to minimize the cost of capital. Now you can see the same thing just expanded. The cost of capital is expanded. Now the cost of equity and the cost of debt. But when you are looking to cost of equity, you will have risk-free rate that will be multiplied with beta, and you will be adding risk premium too. But whereas when it is coming to the debt cost, you will have a tax yield. So debt cost, that is equal to average debt into tax yield. This is a very simple understanding. I'll repeat. The cost of equity will be taking risk-free rate that will be multiplied with beta plus risk premium. And cost of debt, we have to give an importance for the tax. So average debt into tax yield. Now anyway, we will be doing some problem in that you will come to know that. Kindly wait for a moment. You can take your notebook and whatever the calculations we are going to do, please you can do along with me. Yeah, please. How to calculate the cost of debt? I request everyone closely observe, and you can take your pen and notebook and you can do necessary calculations along with me. A company has a total debt of 5,696 crore, out of which it has a short-term loan. 30% of the loan belong to short-term, taken at the rate of 5% per annum. Second part comprises long-term loan, approximately 45% of the loan size, taken at 7% per annum, and bonds that amounting to 25% issued at 8% interest rate. So there are three components. They have 5,696 crore debt, out of which 30% belong to short term, borrowed at the rate of 5%, and 45% belong to long term, borrowed at the rate of 7%, and bonds comprising 25% issued at 8% interest rate. You are supposed to calculate cost of debt for this company. Now you can look into the image. I made an illustrative here. Cost of debt you have to calculate. It's very simple. Average interest what you're going to pay for all three categories: short-term loan, long-term loan, and bonds combined together. It's mentioned as average interest payable into we have to give an effect for the tax 1 minus effective tax rate. See here, you look into that we are going to make the payment for a short term, which is comprises 30%, which is given here. Short term debt, ST debt, long term debt, and bond. 5%, 7%, and 8% respectively. And the component you look at the weight: 30% of short term, 45% of long term, and 25% of bond. So if you combine together, that is we are multiplying with 30% into 5% plus 45% into 7% for the long term debt plus 25% into 8%. If you go for a simplification, you'll be getting 6.65 percentage into 1 minus effective tax rate. So average interest payable into 1 minus effective tax rate. That's the original formula. So we have calculated average interest payable as 6.65 into 1 minus effective tax rate. You can assume 25%. So 25 1 minus 25. So you are getting 5%. So as per the question asked in the problem, what will be the cost of debt of the company is 5%. What it means, if company earn 100 rupees, 5% the company will be paying towards cost of debt. I think you got a clear idea. If you want to learn again, just you can slow down the video. You can again start from the this page, and you can continue watching. Let me do some of the problem just to familiarize. Okay, you can go for a fast track mode. The first problem is all about cost of debt before tax. Look into the problem. A company issues bonds with a face value of 1000, paying an annual coupon of rupees 80. The bonds are currently trading at 950 rupees. Calculate the approximate cost of debt before tax. Very simple. Okay, cost of debt, annual interest, how much you are giving okay, against the market price. It's very simple. Annual interest divided by price. That's all. Interest is 80. Annual coupon we are paying 80 divided by 950. So if you simplify and convert into percentage, you'll be getting 8.42 percentage. I think you'll get a clear idea about this. Come to the second problem. We are going to calculate the cost of debt after tax. A company issues bonds with a face value of 1000. You can take the same, paying an annual coupon of rupees 80. The bonds are currently trading at rupees 950. The corporate tax is 30%. Calculate after tax cost of debt. It's very simple. Let's take the cost of debt into 1 minus tax rate. So as far as this problem is concerned, okay, the cost of debt you have already you have to calculate. It's very simple. Annual interest divided by market price. Yes. 80 divided by 950. So you'll get 8.42 percentage. We have calculated in the previous problem. So 8.42 into 1 minus 0.30. How you got 8.42? It's a very simple calculation. 80 divided by 950. Okay. Annual interest divided by annual market price. And now if you look at the cost of debt after tax, 5.89. But whereas before tax we have computed in the first case 8.42. Now it's only 5.89. This advantage you will get it with the help of tax impact. The third problem is related to cost of equity, dividend discount model. A company pays an annual dividend of rupees 5 per share. The current market price of the stock is 100. The dividend is expected to grow at 5% annually. See here, simply annual dividend and stock price is given very simple. 5 divided by 100 we used to put. But the dividend is expected to grow at 5% annually. So every year 5% has to be added. So that's why it is added as the dividend discount model. You are supposed to calculate cost of equity. Like similar one, dividend divided by price. Dividend is given in the problem as 5 divided by 100 plus growth rate 5% is given. So if you convert into decimal, 0.05, which is nothing but 5%. So 5 divided by 100, that's also 0.05 plus 0.05. So if you convert that one, okay, it will be coming as a 10%. So the company cost of equity when the dividend is expected to grow at 5%. So it's clearly it's visible. So you can easily understand how to calculate cost of equity. Okay, when a dividend is expected to grow. Now you can find the entire picture illustrated with the help of this diagram. Weighted average cost of capital. There are two components we have already discussed. One is cost of equity, another one cost of debt. While we are calculating cost of equity, we have taken equity risk premium into beta, I think, and also we have considered risk-free rate. That has resulted in cost of equity. Likewise, we have computed cost of debt by taking into the consideration of average yield on debt that was multiplied with tax shield. We got cost of debt after tax. So cost of equity as well as cost of debt together, if you combine both the things, that's known as weighted average cost of capital. Let me discuss the cost of equity. How to calculate the cost of equity? Cost of equity is expressed as CE. Cost of debt is expressed as CD. C is equal to RF, which stands for risk-free rate, plus we'll be adding extra, which is called as risk premium, RP. Okay, it is expressed as RP. So cost of equity, that is equal to risk-free rate plus risk premium, RF with RP. And when it is coming to the cost of equity, again, if you go for the extra, as I already told, it's called as risk premium. If you expand that one, say C is equal to RF plus the risk premium. If you go for expansion, put it in a perfect formula, CE, that is equal to RF plus beta into RM minus RF. You know very well, okay, this beta is nothing but stock beta. RM stands for return expected from the Nifty or Sensex. So how much money you expected? This is a simple explanation for the formula. We'll do some of the workings which will give a clear cut idea. Just you can recollect the memory of the previous slide. Now look into that. The cost of equity, that is equal to RF. RF stands for risk-free rate, assumed at 6%. Beta is given as, that stock beta is given as 1.2. And whereas the RM, return expected from Nifty and Sensex, that is expected at 12%. Whereas we mentioned as RF is nothing but risk-free rate, so it's given here. Just we are substituting the value. Cost of equity is equal to 6% plus 7%. Risk-free rate is 6% and risk premium is 7%. So 13%. The cost of equity is computed as 13%. Let we do calculation of cost of equity. And given a risk-free rate RF 4%, beta 1.2, market return 10%. You are supposed to calculate the cost of equity. CE, I think you know the formula, RF plus beta into RM minus RF. So just look into the value. RF is given as 4%, beta given in the problem 1.2, RM 10%, and RF is given in the problem 4%. So substitute all the values in the formula. With the help of further simplification, you will get 4% plus 1.2 into 6%. And further simplification resulted in cost of equity, that is equal to 11.2%. I think now you got a clear idea of the flow of formula as well as substituting the values and subsequent results too. Just to get a familiarity, let me do one more problem. Calculation of cost of equity. Kindly ignore if it is repeated. Risk-free rate is 5%, beta 0.8, market return RM is given in the problem 12%. You are required to calculate the cost of equity. So just quick reference, CE, that is equal to RF plus beta into RM minus RF. The value you take, RF 5%, beta is 0.8 and RM is 12% and RF is 5%. Substitute the values in the formula. Go for a further simplification. 5% plus 0.8 into 7%. So it will result in 10.6%. Let me use CAPM, capital asset pricing model. Look into the problem. The risk-free rate is 6%. The expected market return is 12%, and the stock beta is 1.2. Calculate the cost of equity using the capital asset pricing model. It's very clear how we're going to write the formula. Cost of equity is equal to risk-free rate plus beta into market return minus risk-free rate. So here it's given cost of equity. We are going to calculate risk-free rate will be taken as a base 6% plus 1.2. The 1.2 is given as beta into market return, yes, 12%, and the risk-free rate is given in the problem 6%. Substitute the values. 6% plus 1.2 into 6%, 6% plus 7.2%, and finally we'll get the answer as 13.2. I think you were also hope up with the formula utilization, the value substitutions, and the other thing. I think now you are able to do the problem with a little speed. Let me go little advanced problem now. We go for one more problem in weighted average cost of capital. A company has 60% equity, 40% debt in its capital structure. So it's 6:4. The cost of equity is 12%. The after-tax cost of debt is 6%. Calculate the WACC. We have already taken the formula. Weight of equity 60%, cost of equity 12%, and weight of debt is given 40% into cost of debt. After tax, it's given as 6%. Simplify. Okay, you'll be getting 7.2 plus 2.4, 9.6%. Yeah, you people are also able to do it. With high speed. Good. Now look into the image, which will tell you the entire story about weighted average cost of capital. Cost of capital, yes, you can look into this cost of capital in two perspectives. From businessman perspective, uses it to do the feasibility study to new business ventures, whereas the investor uses it to judge what minimum returns a company must yield for to shareholders, and if it has profitability numbers to support it. Weighted average cost of capital, that is equal to equity divided by, we used to express with V as a total funds involved. So equity divided by equity plus debt into cost of equity. Likewise, debt divided by equity plus debt, total funds involved, into CD, cost of debt. So equity and debt, two components. Equity divided by total funds involved, equity plus debt. Likewise, debt divided by equity plus debt. And here the equity is multiplied with cost of equity, debt is multiplied with cost of debt. This is a simple understanding. Let me calculate WACC. Let's first recall the capital structure of the company. In equity, weight is 39%, and of course the remaining is going to be a debt, 61%. Now the various sources mentioned in this problem: total share capital 98.86, reserves 3,531. Both the things belong to equity, so that's the thing given as the 39%. Remaining debt 5,696. The loans that amounting to 61%. And total, if you combine all together, total share capital, reserves, and total debt put together, it's coming around 9,326. can be in crore. Now we are going to calculate weighted average cost of capital. So just recollect the formula what we have discussed in the last slide. Equity divided by equity plus debt into cost of equity plus debt by equity plus debt into CD. So which is amounting to 8.12%. I think now we'll get a clear cut idea. Let me try with one more problem. Company X has 6 lakh rupees 6 lakh worth of equity and 4 lakh worth of debt. Cost of equity is 14% and cost of debt after tax is 8%. Tax rate is 30%. Calculate weighted average cost of capital. This is a problem you have to work out now. Just you first take the total capital 6 lakhs plus 4 lakh. Which will be a denominator. So total amount is 10 lakhs. So it's very simple. In the case of cost of equity, you will put 6 lakh divided by 10. Whereas in the case of debt, you will put 4 lakh divided by 10 lakh. Yeah. And you have to understand the weight of equity is 6 lakh divided by 10 lakhs. That 0.6. Weight of debt, 4 lakh divided by 10 lakhs. 0.4. 60/40. And go for after tax cost of debt 8%. 8% into 1 minus tax rate 30%. So if you go for a further simplification, you'll get 5.6. And now we are going to calculate WACC. 0.6 into 14% plus 0.4 into 5.6%. That is equal to 10.64%. I think now we're able to understand very easily. This question is going to be something different. Interpretation of results. If a company's weighted average cost of capital is 12%, what does this mean for the company when evaluating new projects? Now you got 12%, how to interpret? So 12% of the weighted average cost of capital means the company needs to earn at least 12% return on any new project to cover the cost of financing, both debt and equity. So projects with expected returns above 12% add value. So this is 12% is a minimum ceiling, and if any project which is able to yield 20%, 25% above to 12%, you can consider. Otherwise, the projects which are having a yield percentage below to 12% can be rejected. This will be the final verdict or interpretation. We will be taking it from this WACC. Calculate weighted average cost of capital for ABC Limited. You can also do the calculation simultaneously. First read the problem and understand. Equity capital 10 lakhs. Debt capital 6 lakhs. Total capital 16. So it's going to be a 10:6. The debt equity proposition, okay, if you look at that, 10 into 6. And the company provides additional information. The cost of equity is to be calculated using dividend discount model, DDM. Last year dividend 4 per share, rupees 4 per share. For each share they given 4. Dividend growth rate 6% per year. I think remember we have taken this one. Current market price of the share rupees 80. The company's cost of debt before tax is 9% based on current borrowing. The corporate tax rate you have to assume at the rate of 30%. So what are the basic information required? Debt and equity, that is 10 lakhs and 6 lakhs. And any last year dividend 4%. Dividend growth rate 6%. And market price 80. And cost of debt before tax 9% and corporate tax 30%. Let me work out the problem. Let me calculate the cost of equity by using DDM. The formula, I think you know very well, cost of equity KE is equal to D. D always stands for a dividend portion. P stands for price. So D1 divided by P plus G. G is nothing but growth expected. So D1, that is how you are going to calculate. We will be taking the base rate. So last year dividend is 4. we are taking 4. 1 plus growth G, we expect a growth of 0.06%. That is 6% per year. It's given in the problem. So D1 we have calculated. Now let me look into the P. P is nothing but market price 80. So G is given in the problem itself. Growth rate 6%. Just we are substituting the value and we will be getting 11.3%. That is 4.24 divided by 80 plus 0.06 of growth rate. That is equal to 0.053 plus 0.06. I think you can also cross check the answer. Hope everyone able to compute, and you are obtaining 11.3. And go to the next step. You have to calculate after tax cost of debt. Cost of debt KD, cost of debt into 1 minus tax rate. Tax rate is given in the problem. It's given as 30. So 1 minus tax rate, you will be getting 0.70. So KD is equal to cost of debt. Cost of debt, yes, it's given as cost of debt before tax, 9% is given. 9 into 1 minus 0.30, which is nothing but 9 into 0.70. If you calculate, multiply 9 with 0.7, you'll get 6.3%. And coming to the third element, calculate, you have to calculate the proportion of debt and equity, both the things. So we have taken total cost given in the problem, 10 lakhs, a portion, total cost, total capital is given 10 plus 6 lakh 16, and weight of equity is already given 10 lakh in 16 lakhs. So it's, and likewise weight of debt is 6 lakhs out of 16. So that's amounting to that is 63% and 37%. And we are going to calculate the weighted arithmetic cost of capital. That is equal to, first we will take the weight of equity and KE, you will multiply plus weight of debt plus KD. 0.625 already calculated into 11.3%. That is nothing but KE, we have already calculated in this step number 1. And here WD, 0.375 into 6.3%. 6.3 is calculated in this step 2. And put together 2.36 plus 7.06, which is amounting to 9.42. Yes, I think many of you are able to complete this one. This is the maximum amount of problem, maximum difficulty level you will have it. Very simple. Understand the component of debt, and to understand the component of equity and the percentage involved. Now you have to make your interpretation. Please recollect the cost of equity we have calculated 11.3 and cost of debt 6.3, and of course the weighted average cost of capital 9.42%. Now we have to interpret. So ABC Limited must ensure that any new project they invest in earns a return higher than 9.42, and cost of debt plus equity combined together, WACC, amounting to 9.42. Whether the company is earning a profit or not, the company has to pay 9.42. So the company must ensure the project yield more than that. So 9.42 is the minimum required rate, considering both debt and equity financing. So you can consider any thing which is go above 9.42. Say for example 15%, 20%, I have already mentioned in the earlier example too. And I think this will give you a complete story or picture to understand 360 degree about cost of debt and equity. Now it's your turn. I given some of the exercise to you. You can practice. And you can spend some time in recollecting all the formulas and method of computing the values, and equally interpreting the results too. I hope the cost of capital chapter is very useful for you. Started from the scratch level, fundamental meaning, and cost of debt, cost of equity, and also we went for weighted average cost of capital. I think this is going to be more than enough for you to prepare for your examination as well as to excel. All the very best. Like our channel, comment and subscribe. All the very best.